There is an investment strategy so simple it fits on a napkin, and it outperforms nearly every professional money manager on the planet. It is called index fund investing, and understanding why it works and what it cannot do will change how you think about building wealth. Let us start with the fundamental problem. The financial industry employs thousands of brilliant, highly motivated, extremely well-compensated analysts and portfolio managers. Their entire job is to find undervalued securities and outperform the market. And yet, according to the S&P SPIVA report published annually, 92% of actively managed large-cap U.S. funds underperformed the S&P 500 over the 20-year period ending in 2023. This is not a bad year phenomenon. It is a structural, persistent pattern that has held across virtually every market and every time horizon studied. The reason lies in what economists call the efficient market hypothesis. In its semi-strong form, this hypothesis holds that all publicly available information is already reflected in stock prices. Therefore, no one can consistently generate excess returns by analyzing that information, because it is already priced in. Any information you have about a company, earnings reports, economic data, analyst ratings, has already been analyzed by thousands of other market participants with the same or better data. The moment new information becomes public, prices adjust almost instantaneously due to algorithmic trading. The only way to consistently outperform would be to have either better information, which is increasingly illegal under insider trading law, or a genuinely superior analytical framework that the market has not yet adopted. An index fund sidesteps this problem entirely. Instead of trying to pick winners, it simply buys every stock in a given index, like the S&P 500, in proportion to their market capitalization. It does not pay analysts. It does not trade frequently. Its costs are near zero. The Vanguard 500 Index Fund charges 0.03% per year in fees. The average actively managed fund charges 0.6 to 1.2%. This difference in fees compounds dramatically over time. A 1% fee difference on a $100,000 portfolio over 30 years, assuming 7% annual returns, costs you approximately $94,000 in lost compound growth. Jack Bogle founded Vanguard in 1975 and launched the first index fund available to retail investors. For years, the financial industry mocked it as Bogle's folly. By 2024, passive index funds held over $30 trillion globally, and Vanguard alone manages over $9 trillion in assets. The math is simple but profound. The aggregate return of all investors in the market must equal the market return, before fees. Active investors as a group must earn the market return before costs. After costs of fees, transaction costs, taxes from turnover, active investors as a group must earn less than the market. Some active managers do outperform, but identifying them in advance is nearly impossible. A famous study by finance professors Fama and French found that the small number of funds that outperform in one decade have only slightly better than random odds of outperforming in the next. Past performance does not predict future performance in any statistically reliable way. This is why John Bogle's famous recommendation was to buy the total market index fund, hold it forever, and ignore the noise. Warren Buffett has made the same recommendation repeatedly. In his 2014 letter to Berkshire Hathaway shareholders, he wrote that his instructions for the trustee of his estate are to put 90% into a very low-cost S&P 500 index fund. Here is what index fund investing cannot do. It cannot protect you from drawdowns. In 2022, the S&P 500 fell 19%. In 2008 and 2009, it fell 57% from peak to trough. A passive investor must have the psychological fortitude to hold through these declines and not sell at the bottom, which is exactly what most retail investors do wrong. Studies by Dalbar Incorporated consistently show that the average equity fund investor earns significantly less than the fund itself due to buying high and selling low. In 2022, the average investor earned 3.8% less than their fund due to poor timing decisions. The behavioral gap is larger than the fee gap. Index investing also does not solve portfolio construction. You still need to decide your allocation between stocks, bonds, and other assets. You still need to rebalance. You still need to understand your risk tolerance and time horizon. Tools like target date funds bundle all of this into a single instrument. Buy a 20/50 fund, contribute regularly, and let the fund automatically shift from aggressive to conservative as your retirement date approaches. The practical takeaway is straightforward. If you are not a professional investor with genuine edge-specific domain expertise, proprietary data, or unique analytical capability, the evidence overwhelmingly supports putting money into a diversified low-cost total market index fund consistently, reinvesting dividends, and leaving it alone for decades. The enemy of this strategy is not market volatility. It is human psychology, the temptation to act, to react to headlines, to try to time the market. Every time you sell in a panic or try to shift into the hot sector, you are betting you are smarter than the aggregate of every professional investor in the world. The data suggests you almost certainly are not.